$2 million in 3 hours!
You can do it in just 30 minutes if you learn how to spot high-quality demand and supply zones. In this video, I'll show you 8 powerful supply and demand zones and a proven strategy to trade them. Watch it till the end and you'll be ready to start earning. There are 8 key areas for us to focus on, and the first is whether the zone led to a break of structure. This is the simplest and most effective filter that you can use. It takes a ton of money to break structure on a liquid instrument, and the more significant that the structure breaks, the more significant the zone. Swing structure is stronger than internal, which is stronger than fractal. So zones that cause a break of swing structure, they're going to be the most likely ones to cause the next break of swing structure. Here you can see this demand zone broke the daily swing high. So then when price returns to the zone, there is enough demand within there to break the next swing high. Number 2 is if it is a flip zone. Now the key here is that you must see that interaction between supply and demand until one overpowers the other. Here you can see supply was in control, but when price returns to it, supply tries to make a lower low, but it fails to do its job because huge demand steps into the market to overpower it. That pattern then shows us that supply has now flipped to demand, and this is a high probability area for us to get long. But remember, you must see that interaction first for it to be valid. Number 3 are sweep zones. These are zones where liquidity is swept and taken as they are created. But why is this important? Well, remember, institutions need opposing liquidity for them to trade against, so that they can get minimal slippage when they enter and exit the market. So if they're buying, they need a lot of supply to buy against. There will be a lot of sell orders below this low, and that's generated from people's stop losses from early buyers and then breaking. So if you see a sweep zone, this signals it was created with institutional involvement. Number 4 is inducement, and this is another liquidity concept that can get very technical, but essentially, you just want to see, is there available liquidity in front of the zone? Why? Well, same reason as before. Institutions are going to need that opposing liquidity to enter the market with minimal slippage. Here you can see there is available liquidity behind this low for institutions to use to buy against. But if there isn't any available liquidity, then very often these zones are traps, and they will usually fail. Here you can see that there is absolutely no available liquidity in the leg, so this is a very obvious trap, as institutions will not be selling it. Number 5, do you have alignment with the higher time frames? The more time frames that you have aligned, the higher probability of that trade here. It might look like a high probability sell to follow the bearish trend on the M5, but the M15 is bullish, and it's just mitigated the M15 demand at the strong M15 low. So now the M5 is likely to also switch bullish. Understanding multi-time frame analysis will help you to avoid a ton of losses, as time is power, and higher time frame will usually win. Number 6. Is the zone unmitigated? It's just a fancy way of saying, is the zone completely fresh, or has it already been touched? Because if you see a zone with touches, then it's very likely that a lot of the resting orders within that zone have already been filled. So I try to focus on zones that are completely fresh, as these usually give the strongest move when price mitigates them. Number 7. Is the zone well priced generally? The highest probable demand zones will be buying in discount prices, which is in the bottom 50% of the range, or selling premium prices in the top 50% of the range. This also improves your risk reward because we want to buy low and sell high, right? And last but not least, number 8. Is the zone stacked with another high time frame zone? The more you can stack zones across time frames, the more orders there should be in that area, increasing the probability of the move. Now combining as many of those confluences together are going to give you the highest probable institutional demand zones to trade from. Alright guys, we've already gone over all the rules. Now the big question is, how do we actually apply them in our trading to make a profit? Let's break it down together. We'll start by looking at the 15-minute time frame. As you can see, the market was initially in a bearish trend, forming lower lows and lower highs. But then, something important happened. We got a break of structure. That means the market shifted from bearish to bullish, changing the overall structure. According to our first rule, spotting the break of structure is the most important thing. Once we see that break, we expect a pullback, followed by an impulsive move in the direction of the new trend. In this case, to the upside. Since the break of structure happened right here, rule number 2 is the flip zone. So where's the flip zone on this chart? Take a look at this area. It was previously a supply zone where prices reacted and then broke structure. Because that zone caused the break, it now becomes our flip zone. It's no longer acting as supply, but potentially as demand. And remember, if a zone doesn't cause a break of structure, it's not a valid flip zone. Now on to our third key concept, the sweep zone. There are 2 ways a liquidity sweep can show up. First, when a demand zone gets swept, meaning a candle wick dips below a previous low inside a range, right at or near demand. Second, during a pullback, where liquidity is taken out before a move in the new direction. This type of sweep acts as a strong entry confirmation. In this current setup, if you look to the left, you'll see a clear liquidity sweep. That sweep led to the creation of the flip zone, which then caused the break of structure. So this entire setup is confirmed and aligns perfectly with our rules. Let's move on to point number 4, inducement. Now, if you look at this chart, you won't spot any clear inducement. You might be tempted to think this area right here is inducement, but it's not. Why? Because that level is part of a demand zone that has already been mitigated. It was actually part of a flip zone that price tapped into before the break of structure. Since it's already been used, it no longer qualifies as inducement. Instead, it now acts as a supporting part of our new flip/demand zone. So what does the lack of inducement tell us? Honestly, it gives us a strong clue. We're likely to see a liquidity sweep during the pullback. Think about it. If clear inducement had been present, the market could have just swept that level and continued higher with only a shallow pullback. But since there isn't any obvious inducement here, price will probably dig deeper to grab liquidity before the next move up. And that's exactly what we want to be prepared for. Quick note, if you're unsure about terms like inducement, entry confirmation, or liquidity sweeps, I've got a full video on my channel breaking it all down with easy-to-follow examples. Definitely check that out if you want to level up your understanding. Alright, now on to our 5th point, alignment. What do we mean by alignment? It simply means checking if the trend on our current chart, the M15, matches the direction of the higher time frame. So in this case, our M15 bias is bullish. But what about the higher time frame? Is it also bullish? And if so, how far can this move potentially go? To find out, let's jump over to the 4-hour chart. Okay, now we're on the 4-hour time frame. As you can see, there was a major break in the swing structure to the upside. After that break, price created an extreme demand zone down at the bottom. What happened next? Price pulled back into that demand zone, and after tapping into it, we got a change of character, signaling a shift back into a bullish trend. That's our confirmation. The M is now bullish, and it's in sync with what we're seeing on the M15. So with both time frames aligned, we can confidently expect a new impulsive move to the upside, continuing the 4-hour trend. Now, let's flip back to the M15 chart. Looking at it now, everything makes sense. Our bullish continuation on the M15 is fully backed by the 4-hour structure. Both time frames are pointing in the same direction, giving us a clear bias and a high probability setup. Moving on to point number 6 on our checklist, the unmitigated zone. When we look at this price leg, the flip zone we identified earlier is also unmitigated, and that's a key detail. Why? Because unmitigated zones act like magnets for price. So the fact that this area is both a flip zone and unmitigated adds even more strength to our bullish bias. It gives us greater confidence to look for a buy entry, since it's a high probability zone for a reaction. Next up, point number 7, premium and discount zones. To spot these, we use the Fibonacci tool, drawing it from the most recent swing low to the swing high. Anything below the 50% level is considered the discount zone, and anything above is the premium zone. And the rule is simple. In a bullish market, we want to buy from the discount zone. As you can see, price has pulled back right into our discount area, which makes it an ideal spot to consider a long position. This adds another layer of confluence to our trade idea. And finally, let's talk about point number 8, and this might be the most important one, the stack zone. This concept is powerful. A stack zone is when a lower time frame point of interest is located inside a higher time frame point of interest. Let's apply this to our setup. We've been watching that M15 demand flip zone closely. Now we want to see if that zone also sits within a larger zone on a higher time frame. Remember the 4-hour analysis? After the fractal change of character, price formed a large 4-hour demand zone. And as you can see, our M15 zone is sitting right inside that 4-hour zone. That's exactly what we call a classic stack. The higher time frame demand zone literally contains the lower time frame one, and this alignment between time frames gives us one of the strongest bullish confirmations possible. It shows that both time frames are pointing in the same direction, which significantly increases the probability of a successful trade. Alright, so we've checked off all our confluences. Thoughtful. Now the big question is, how do we actually enter the trade? Analyzing the current price action. Price has tapped into our M15 demand zone, but notice, the fractal high is still intact, and more importantly, no major liquidity has been taken yet. Since we're expecting a sweep, we need to be patient. Next, we see a small push up, but it fails. That failure creates a fractal change of character to the downside. Then it happens. A big candle drops and sweeps the previous low, taking out liquidity. That's the stop hunt we were waiting for. So, what just happened? Traders who jumped in too early placed their stop losses just below that low. This sharp move down hunted those stops, a classic sign that institutional money is stepping in. Now that we've got our confirmation, the liquidity sweep, it's time to act. Entry plan. Draw your liquidity zone. Place a buy limit order at that level. Why a limit order? Thoughtful. Because after a strong sweep, price often moves fast, and you might miss the entry if you wait for more confirmation. Set your stop loss just below the demand zone low. Your target is the recent swing high. Now, let's see how price reacts. A candle moves up, and then a strong bullish candle breaks the structure to the upside. That's what usually happens after liquidity is taken. Price doesn't waste time. It moves with speed. The size and aggression of the candle tells us smart money has entered the market. And that's the strategy, guys. That's how you use the 8-point checklist to find a high-probability setup and execute with confidence. If you've made it this far, I know you're serious about learning how to trade. Excited? Drop a comment below and let me know. I'd love to hear from you. Okay, let's break down one more example, step by step. We're looking at the M15 chart, and as you can see, we've had a break of structure. We've already marked up all of our confluences: liquidity, supply and demand zones, the flip zone, higher time frame alignment, the stack zone, premium and discount levels. Now remember, after a break of structure, we usually expect a pullback. But in this example, there's something a bit different. This time, we clearly have inducement in the market. Because this inducement is sitting there, our theory is simple. Price will likely pull back, sweep that inducement liquidity, and then continue the impulsive move higher. That's exactly what the inducement concept helps us anticipate. And look what happens. Price breaks structure, then pulls back. Notice this big candle that drops right into our demand zone and leaves a huge wick behind. That candle is very telling. It's a classic sign of strong buying pressure. It shows that buyers are stepping in aggressively and pushing price up. This gives us our entry signal. Here's how we set up the trade. Entry. Place a buy limit at the top of that candle's wick. Stop loss. Just below the low of the demand zone. Target. The weak high above us. Now, why are we confident here? Because that inducement liquidity has already been swept, which means the path of least resistance is now to the upside. So we expect a strong continuation. Let's see how it plays out. Our buy limit gets triggered, and look at that. Price takes off with big, powerful candles, heading straight to our target. Target hit. Beautiful. You can clearly see what's going on here. The strength of this move shows how many buyers stepped in after that liquidity was taken. You can actually feel the volatility and momentum behind this move. This is why understanding liquidity is so important. When you combine it with market structure, supply and demand, and your other confluences across multiple time frames, you start to find the highest probability setups, the ones that really move. I'll be bringing you more real, practical trading videos just like this one. Don't forget to like the video and subscribe to the channel so you don't miss what's coming next.